Okay, so now we're looking at the eternal rate of return in an investment. And as you can see here, Excel has a lot of very good formulas for analyzing the investment. And one of the most important one is the eternal rate of return. And you can compare it perhaps to return on assets when we are analyzing the balance sheets and profit and loss accounts, the financial reports from a company. We normally use the return on assets, showing how much profit the company is making in relation to the invested capital. And we could say that the eternal rate of return is equivalent to that KPI, showing the rate of return of an investment. So I'll just show you this short example here. Well, we're talking about an elderly woman who wants to make a property investment of 5 million DKK. And the property consists of two apartments, bringing in a net profit of 12,000 per month. And even though it's an elderly woman, she says after 20 years, we expect to sell the property at a price of 4.5 million. Now, instead of investing in this property, she considers to buy bonds giving a yearly interest of 4% per annum. So which option should she choose? Well, we can calculate the first possibility, the property, and see what is the eternal rate of return per year of that investment to compare. And here again, we go into Excel and use the eternal rate of return, or the rate. You saw here that we have two possibilities: eternal rate of return or the rate. We have the same thing when we use the Danish. You can just change the language setup. So we have two possibilities. And you can see the difference here. If we take rate, it's the same payment every year. Eternal rate of return, well, here you can continue to put in values, different values. If we, for instance, said, well, the first year they will only bring in 10,000 per month, and the next year they will bring in 12,000 per month, and so on. But now we are calculating on 12,000 per month in all 20 years. So let's see what is the return on assets or eternal rate of return in this situation. So I'll go up and grab this rate, and I'll say that, well, the number of periods here, well, we're talking about 20 years, and we have a profit every month. So it's 12 times 20. So it's actually 240 months. So it's a fairly long time investment. And the payment, the profit I get every month, 12,000. And the present value was minus, because I'm paying out 4 million. And I get back 4.5 million at the end of the 20 years. So I get an internal rate of return of, well, from the first point of look at it, it's 0%, but remember it's per month. And let's see, it's 0.3% per month. So if I'm going to calculate that into a yearly, because this is 4% per year, so I can say, and here we have to know the way to calculate the effective interest, and that is 1 plus the interest lifted up to how many times we calculate per year, minus 1, So actually, it's giving me a yearly percentage of 4. So 4.1. So a little bit more than investing in the in the bonds. So now you're the one to decide which one to pick. The bonds is perhaps a little bit more secure. And this one here, there are some ups and downs. Maybe we can get more here. But this is what the calculation shows. So not much difference. So this is how you calculate the internal rate of return of an investment, and you can compare that with what we talked about in financial analysis of financial reports with return on assets. Thank you very much.